the warm introduction. So I noticed when I was at the bar that we already have some people here who are aware what Maker does. So what I'll be doing tonight, I'll be trying to make the case why we believe at Maker that decentralized stablecoins can actually be a huge driver for blockchain adoption and kind of usher in a new wave. So in order to do that, we'll need to go back to the beginning first and kind of remind ourselves what really blockchain started with, what the origin was, and as everyone here knows, of course, the beginning was actually Bitcoin. So where did Bitcoin come from? This was the 2008 financial crash that really upset a lot of people. There are these, by now, very famous articles from the newspaper, and as everyone here probably knows, one of those, like the chancellor on brink of second bailout for the banks, is even coded into the first Genesis block of the blockchain, of the Bitcoin blockchain. So why is this important? Because we want to make sure with Maker that we actually stay true to these original concerns. And what was originally so attractive about Bitcoin, I think, can be maybe summed up in these 4 points. So the first thing is the fact that Bitcoin is, of course, decentralized, which is very different from the 2008 banking system that had these central institutions that really were too big to fail. Second thing is that within Bitcoin, code is law. There are no exceptions to the rule. The blockchain executes whatever is in the code, and once again, this is very different from the economic environment in the 2008 banking crisis, where moral hazard and the banking bailout was kind of an exception on the normal economic rule that whoever takes a risk should also bear the responsibility and live up to that risk. The fourth element that I want to highlight is transparency. So although that sometimes becomes a problem when the blockchain transactions, maybe we want to have some private data in them, it's quite a new thing that we are tackling, but actually at this point we should remember that transparency is one of the key elements that really drove the popularity of Bitcoin. And then last but not least, trust element. So whereas the banking system requires a lot of trust in institutions and people, the blockchain really is trustless. So yeah, if Bitcoin has all these properties, then why do we need something more? I think we're all very much familiar with this graph. So to me, this kind of summarizes both the strength and the real weakness of Bitcoin. So what we see is a Bitcoin price that started at $880 and ballooned up to almost 20K, and then went back and really, when the bubble was bust, then a lot of people lost a lot of money. The reason for this is quite simple. It's because Bitcoin really has a fixed supply, and when demand changes, the price rates, they really go up and down in function of the demand. Now, if you're a speculator, then this is great news. There is a lot of money to be made, a lot of money to be lost as well. But for really practical applications, this isn't really workable. And this is probably the weakest point of Bitcoin from definitely, for example, a business point of view. So it's kind of obvious. This is a quote from one of our business partners, Tradeshift. Specifically, for example, here in the Tradeshift business, which is supply chain management, there exactly you can really not imagine using a coin that is as volatile as Bitcoin, because as a business, when you buy products, you need to make a planning, you need to sell them later on. You really can't have it that at one point your Bitcoin is worth twice as much as the moment when you're selling your products, for example. So here is where the concept of a stablecoin, and in our case, the DAI stablecoin, where it enters and where the story really begins. So what is DAI exactly? For us, the main thing is that DAI is a decentralized stablecoin on Ethereum. So we're the first one actually who brought something in production. The idea is quite simple. It's a soft peg to the US dollar. We say soft peg because there might be some deviation, but the deviation is temporary, and the value of the stablecoin goes back to $1 over time. The most important thing that I want to highlight here is that DAI is asset-backed. So there is collateral, as we'll see, on the Ethereum blockchain that really is the backing of that $1 value of every DAI coin. And of course, it does have the advantages of what we are also use of for Bitcoin, so it's programmable money, and it doesn't have a central point of failure. Now, before we go further, I first want to kind of give a one-on-one introduction to the field of stablecoins, because not every stablecoin is the same. So we have three models here that are highlighted, and if we start at the left, the simplest form of a stablecoin is an IOU token, and it kind of takes this simple idea. When you go to an institution, you give them $1, and they will mint $1 worth of coin for you. So they keep it in custody, and in that way, it's very easy to kind of represent this dollar value on the blockchain. The problem, of course, is that this is not really in line with the founding principles that we saw. So it's not decentralized. There are problems with growth, for example. You have the institution, the people actually holding the coins or the US dollar that you need to trust. And this is maybe sometimes a solution for assets if you want to represent them on the blockchain, but very often it's probably not the best solution. The second one that is called here the Seigniorage share, really this is about algorithmic stable coins. And although DAI does use similar mechanisms, an algorithmic stablecoin, what we understand is that there really is no backing with collateral. It is just really money made up out of thin air, but it does have mechanisms, for example, to synchronize demand and supply, to kind of try and hold the coin at the same value. But crucial thing, it is not backed by collateral. And then the third category is DAI. So we do have also mechanisms that I will discuss that kind of regulate supply and demand. But essentially, the most important thing is that it is backed by collateral. So what do I mean by that? In the Maker smart contracts on the Ethereum blockchain, we have this concept of what we call a collateral depth position, or a CDP in short. So what that is it's the possibility for users to deposit collateral, and typically in our current version that is ETH. You can deposit collateral, and let's say that you deposit $300 worth of ETH in the contract, in the CDP that you created. This is the first step to actually create DAI. Because once you have locked up the collateral, you can then draw DAI, so you generate DAI, which is backed by the collateral. And you can do that up to a certain percentage. Now the system makes sure that at all times, all the CDPs are over-collateralized. Of course, we need to set like a percentage or something. So at the moment, this percentage is 150%. So the value of your collateral at all times should be 100% or more of the DAI that you have drawn. And in this way, we can really guarantee that every DAI that is in circulation is backed by at least its dollar value in collateral. Why would anyone do that? Well, imagine that you hold ETH and you want to hold on to that ETH because you believe that ETH will appreciate in value. but at the same time, you want to use its value to do something else, to pay for your rent, to maybe do an investment, anything that you would do in US dollar value. In that case, you can open a CDP, you can lock up your collateral, and in other words, open a long position on the collateral and take a kind of loan against the collateral, which is the DAI that you draw. Now, the most complicated aspect, and this is the trade-off that we have. So we talked about the simple IOU model, which has a big advantage, which is that it's simple to understand. Unfortunately, it's not decentralized and not really in the spirit of blockchain. The trade-off that we have is that the stability mechanism that we support and that we have implemented, that it has some level of complexity. So what we can say is that there are 4 levels that actually guarantee the stability of DAI. First is supply and demand. Second is liquidation. Then we have something called MKR dilution. And kind of a last line of defense is the emergency shutdown. Now, what does that mean? So supply and demand is kind of built in on these CDPs that I talked about. So when you open a CDP, you can make the decision to draw DAI, but you could just as well buy the DAI on the market. So when will you actually draw DAI from your CDP? When will you buy DAI on the market? Well, the answer is it's supply and demand. If on the market the DAI is in short supply, the value of it might be slightly higher than $1. So then it's interesting for you to actually draw new DAI from your CDP because the system will only, quote unquote, charge you $1. Now, in the opposite direction, the same goes. So suppose that on the market there is an oversupply of DAI, then it might be the case that the price is, for example, 98 cents. If you have a CDP and if you have an amount of DAI that you need to pay back, then that is the right moment to buy DAI on the market and put it back in your CDP and pay off your loan. So that is what we mean by stabilizing supply and demand. But that is only the first stability mechanism. The second one is liquidation. If the value of the collateral drops, so if you have ETH locked up, you have a pretty heavy loan that was taken against it, and if the value of ETH goes below a certain level, that's 150% that I talked about, then the system will actually liquidate your position, meaning that it will take your ETH, sell it on the market, and pay off the debt that you owe to the system. All this to guarantee that the collateral in the system is always at least 150% of the debt that has been taken out. Even if we do this liquidation with the safety margin that I talked about, it might still be that there is really a flash crash. That even if we start at 150% collateralization, at the moment when we sell the collateral, might be that it actually already dropped to 95. And then the system might end up in a situation where not every DAI is backed by enough collateral to have that $1 value. So here is another aspect that comes in, which is governance. DAI is not the only token that Maker has. We also create a smart contract for the MKR token, which is the governance token. Now, the governance token, that is actually the right to vote on the risk parameters, such as the 150%. Now, this token appreciates in value when the governors do their job well. So if they choose a safe collateralization ratio that everyone should follow, the system functions well, you pay a stability fee that goes to these MKR holders, and they see their MKR appreciating in value. Now, if liquidation fails, that means that the MKR holders are the lender of last resort. So then they step in, not personally or anything, they don't have to sign a transaction. It's probably better to say that the system steps in, it will generate more MKR tokens, and it will sell it on the market to cover for the gap that wasn't covered by the collateral liquidation. And in that way, once again, we guarantee that for every DAI in circulation, there is enough collateral in the system. So we've discussed 3 mechanisms so far. If all these 3 fail, and there is still a situation where it might be that one DAI is not at least backed by $1 of collateral, and this is a really extreme situation. What you can think about is, for example, a hack of the smart contracts. If that happens, then we have a very last resort, which is the emergency shutdown. What that means is that the system is basically, it's rolled back. So the price feeds that we use as input, they are frozen, and everyone with one DAI, every DAI in circulation is now actually the right, so a claim on the same percentage of collateral that is in the system. So if there is something that we didn't take into account, this is our last resort. This is a system that can actually make sure that everything is gracefully shut down, that the system is settled, and that everyone who owns one DAI still gets their $1 worth of collateral. And those are the 4 stability mechanisms of the DAI stablecoin. Now, we started by saying or reminding ourselves what the strong properties of Bitcoin were. Decentralization, code is law, transparency, and trustlessness. All these apply to DAI. Where Bitcoin, however, has a fixed supply, we devised these mechanisms that give DAI its stable value. Because it's so complex, the only proof really is if we can actually deploy it and really demonstrate that it works. And that's exactly what we did. So at the end of 2017, we deployed the first beta version of our smart contracts. That was probably the best timing that we could have chosen to look for a really hard crash test, because what happened in 2018 is that the bear market in cryptocurrency started. And this is the value of ETH, which depreciated I think to 80% of its original value. So this really is the worst case of the worst case in our scenario, because all the collateral that was locked up, all that ETH depreciated in value, and all the DAI that was taken out in loans was suddenly at risk because the collateral was no longer worth what it used to be. What we found is that the value of DAI did this. It didn't budge. So the system worked exactly as designed. People did add more collateral. Thank you. Dilution. I think it didn't even happen once. I should make the side note here that the beta version actually has a slightly different mechanism, but it's pretty close in principle. Okay, so although it seemed that our beta version worked pretty well, we still want to make sure that we're even better insured against these crashes in the value of the collateral. And the best way to do this is not only support ETH as collateral, but also other types of collateral that are not correlated. So that if ETH crashes again, that you have other collateral such as digital gold, or maybe another tokenized asset that will still contain its value, so that the flash crash isn't actually affecting the value of DAI all that much. And this is what we're currently working on, and hope to release on mainnet within the first part of next year. All right, so I did talk a lot about DAI, and I should look at the timing now. So I think, I talked for 25 minutes, so I'll really quickly go through this part so that there's some time for questions. Maker itself as the organization, as the foundation. So as I said, we launched our beta version. We're still working on multi-collateral DAI. The DAI in circulation really kept growing and growing to the point where currently there is 70 million of USD worth of DAI in circulation. That didn't go unnoticed, so we have a lot of business partners that actually that we added to our integrations and business development teams with Bifrost, Tradeshift, and Wire. And recently, which some people might have noticed, we received an investment from Andreessen Horowitz, the well-known investment company. Bifrost is a charity organization that works with direct donations, so that's what we worked with them on. Wire is an on and off ramp so that people can easily convert USD to DAI and vice versa. And Tradeshift is a platform for small and medium-sized companies to basically digitize their financial administration, particularly paying invoices to each other. And we built a solution for selling invoices that have not been paid yet. So that is also something that we're currently working on. Okay, and then to close with, so I think I brought on a couple of arguments that should show that decentralized stablecoins really are a good candidate to really drive the adoption of blockchain technology. But the thing is, USD DAI is only the beginning. So what we'll work on next after multi-collateral DAI is adding what we call synthetic fiat. Because think about it, the price feed tracking the US dollar price, it's really arbitrary. You can just as well do it for euro, British pounds, Japanese yen, you name it. In fact, you don't even have to restrict this to fiat currencies. If you tweak the system a little bit, you can start tracking stocks, indices, and so on. And that's also something that we are planning to do. So these we call the synthetic assets. And this really makes for an entire ecosystem of financial assets that will be tradable on the blockchain without having to rely on any custodianship whatsoever. So, and that was my talk. Thank you.